So there are several different types of moving averages out there, and really the building block one is the simple moving average. It's the easiest to understand, and really the most common one that's used too. So let's look at that and how that's constructed and how we can apply that. So a simple moving average is basically looking at prices over a time period. So in this example, let's say we were looking at the price of a security over 20 days, and you can see the prices at 20 and 24 and 22, and you're going back, the most recent price would be 29 to the far right, and you go to the left, and the 10 days ago was at 20. So you do the average where you basically, this is a basic math problem, right? You add up the numbers, you divide it by 10 periods there. The average is 24.5, right? And then that's your average based on that time frame. And then on the 11th day, you now drop, your day one figure, the 20 unit, and you add in whatever the current one is, the next day's one. So on the 11th day, which let's say, for example, was 32. And you can see we now recalculate our moving average, and it becomes 25.7 would now be our average over that 10-day period. And you keep repeating the process, dropping, adding, and that gives you this range of prices, right? And that's it's a simple way of doing it. It's a simple moving average, and you're going to basically show a line, how it's going to be graphically and visually represented, showing these prices over time and how they change, going like from 24, then to 25, then it might go down or up, in this example here. And so if we look at like a chart, how this might look is here's our candlestick price chart here for Procter & Gamble, and you can see our candlesticks here and the prices, they're going up and they're going down, looking from the far left for farther back in time to the far right to the more current time frames. And so let's say we want to see a simple moving average. What would that look like if we applied it to this price chart? So what you do is you input some data so into your platform. Very easy. You just have to put basically one number basically, which is you have to choose what moving average you want, and you have to input the time frame. So if we look in the upper left there, where I've inputted for a moving average or a simple moving average would be 50. That would be, let's say, 50 time periods. Let's say they're days. So that would be 50 days. And I put another one on the chart in pink for a moving average over 200 days, just to show the difference between them. So if we look at our price chart now, we see a blue line and a pink line going across it there. And you can see that the blue line, the more recent look back of only 50 days, is showing where it's actually crossing over some of the prices, where some of the prices, the most recent prices are above or below the line. And you can see if we average it out over 200 days, that never happens to cross over. Sometimes it can, it's just in this example, it's not. So if I look at this moving average, if I look at this chart now, I would say, oh, to the far left, there's not really much change. It doesn't cross the line, and then it starts crossing the line for the blue line, the 50-day moving average, and the 200-day moving average is just kind of off by itself. Now let's change the numbers a little bit and see how that might look a little different. So let's say I go in and I input, and I change one of my moving averages to be only 10 days as far as a look back, and the other one, the pink one, to be only 30 days. What does that look like? And as you can see here, it looks quite a bit different, right? Now both lines are crossing over at points, crossing over where the price bars are, where the candlesticks are, and sometimes they cross over each other as well. And what does that mean? And that means something. We're going to learn about how we trade on whether these are crossing prices or crossing over each other is a key indicator we're going to learn about. But for right now, just think about when I change my inputs, what does that change to my simple moving average as far as the look on it? In addition, you can see how we were using candlesticks, but sometimes people like to look at moving averages with like a line chart. And here's an example here of the 50-day moving average over a line chart where the prices are more of lines as opposed to, candlesticks. Candlesticks can tell you a lot more, but sometimes a line chart is helpful just for you to see where the crossovers happen. So it can be visually kind of pleasing in that manner. And as you saw, we can decide to have more than one moving average on a chart. Usually folks will have one, sometimes they'll have two, but you can have more on there if you want as well. That's up to you as far as how many moving averages that you want to have. And that'll be impactful as far as when we get into how to really leverage this, which is with the crossover rule, which is our next lesson, when we're going to talk about, all right, this is great. We have these lines on this chart. Now, what does that mean and what do we do with them? And that's the next lesson.